All right, I'm very, very excited to talk about the economy right now. Unfortunate as it is under dire circumstances with where we're heading in the economy, uh, but it needs to be addressed. We've made multiple changes since the last time you likely have heard from us at ITR. We're going to take a look at the whole COVID-19 situation and its impact on the economy. We're going to hop into some macroeconomic trends and what's going on there. Talk briefly about what's happening in the stock market in the financial industry and whether or not that has an impact on overall business. And then we'll get into the depths of your quarterly report as well. So we will take a look at what's changed since the last time that we've been able to talk here. We will be able to answer your questions and kind of hopefully get a better understanding of what this year is going to look like, what next year is going to look like, and even what the following year after that in a long-term basis is going to look like as well. So to begin, let's hop right into the coronavirus and the COVID-19 situation. Now, what we're looking at here is on that left-hand side, you can see the global deaths as long as the global fatality rate. And to the right, you'll notice each and every country listed, as well as their deaths and their subsequent fatality rate. Now, what you will notice here is that there are not a number of cases. And that's here on purpose because we do not want to track necessarily the number of cases as informing our decision about what's going on with the COVID-19 situation, because the more tests you give out, the more number of cases there will be. So at the end of the day, it's somewhat being biased by the sheer number of tests. The more people you test, the more number of cases there are going to be. We want to look at the death rate. We want to look at the global fatality rate and the differences between each country that's going on right now. So you'll see it's just above 265,000 deaths worldwide. It is a very unfortunate situation. Us economists here, we like to look at the numbers. We like to strip out some of that emotion to try to get a real grasp of where the economy is going and where it's going to be heading in the near and the far term. So what we're seeing here on the right-hand side is the United States is the largest country in terms of the death rate. You have all the other countries listed below as well. And what you'll notice is the fatality rates to the right-hand side. Now, looking at this one screen in particular, this one slide, what we don't see here is the population patterns, the demographic patterns in each particular country. So what this next slide is showing is looking at both the fatality rate but also the percentage of the population above 65. So all the way to the right there, what you'll notice is you'll see that percentage of population 65 plus, and you'll see that these certain countries with higher populations that are elderly likely have higher fatality rates to the left-hand side where my mouse is circling over. Now, these two charts paint the same picture. The top part is looking at weekly deaths, and the bottom is based off cumulative deaths. So at the end of the day, it's telling the same story here, so we can focus here on the top part. Now, what we're seeing is that 23% of Italy's population is above 65, so they're naturally going to have a higher fatality rate because the elderly are more vulnerable to the coronavirus. Similar to the UK, where you see that higher population pattern, as well as Spain. Now, two different factors that are in this and somewhat controlling the fatality rate is culture and aggressiveness of enacting these stay-at-home orders. So we see Germany down there showing really low fatality numbers compared to a high population above 65, compared to, let's say, Italy or Spain. Now think of the cultures between those two countries. When you're in Italy and Spain, when you greet one another, you're giving each other a kiss on each cheek, and it's very more engaging in that sense for how you greet one another compared to, let's say, Germany, which is a more cold or aggressive type of behavior going on there. So lack of contact in Germany, in addition to the fact that Germany was very aggressive in its stay-at-home orders and closing down its economy, which was driving down that fatality rate. So just kind of food for thought to consider not only the fatality rate in itself as a static figure, we need to consider all of these other cultural factors. We need to consider demographic patterns as well in this mix. So the sheer nature of your business is very much tied to manufacturing. So certain states are going to be impacted more or less than the others because manufacturing is a very boots on the ground, engaging type of behavior rather than the service industry, which can still somewhat keep afloat and be mitigated by the coronavirus because they are able to work from home compared to the factories, the plants that are shutting down. So these states in itself that are very strong in its output for manufacturing are going to likely be hurt more severely than service-oriented states that we're operating in. So please keep that in mind as well when you're focusing on your sales and your marketing tactics, that these particular states, everything from Indiana down to Kansas, they'll likely feel slightly heavier of a pull down because of their ties to manufacturing. This is a interesting chart to look at. Now, this is looking at the blue lines. There is the daily number of cases in the U.S. The red line is looking at the cumulative cases overall. Now, what we want is to make sure that these blue daily cases stay below the cumulative total. In the early parts of this pandemic, early on in March, mid-March, early April, we'll notice that the daily cases were above the cumulative cases. This means that the cases are accelerating, they're getting worse and worse. Now that we've seen this somewhat temper off, I don't want to say it's good news because obviously we're dealing with the number of deaths here. That's never good news. But it is somewhat encouraging to see the fact that we do have those blue daily death numbers below the cumulative total. So there is a light at the end of the tunnel. If we're enacting, if we stay at home following the rules, hopefully this thing will come to an end in the summer months. Now, that is a big assumption to make, and we made those assumptions when it comes to our overall expectation for the economy. We integrate new information each and every day here at ITR. So what we're doing is right now, we did lower our expectation for the economy because of this coronavirus, because of the lack of optimism in the economy, lack of spending. And you'll see that both in the data points for the economy and the data points for MTI in general. We did make a revision downward to consider those factors at play. So let's take a look at some economic fundamentals. Let's look at where the economy is going. And our largest metric that we track here in the United States is GDP, gross domestic product. So this is the largest number we can get a hold of in the United States. And what this is looking at is the solid blue is historical data. The bars there, the teal bars, is our forecast for GDP through time. Very similar to the structure of your MTI report, and some of those pages include a setup like this. Now, we are going into an actual recession in the consumer economy in the next 2 quarters. That is very different from our previous forecast, which was just calling for a slowdown. The definition of recession is constituted by 2 consecutive quarters of decline. We're going to see that now. We didn't expect that in our last conversation. Now we do. Now, somewhat of a silver lining out of all of this is you may have heard me talk about last time around that we were calling for a softer decline, softer recession in 1920, and then a more severe downturn in 22 and into 23. Those roles have somewhat been reversed now, where this time around, the coronavirus, the plays at hand have somewhat pulled in that negativity from 22 into 23 into where we are today. So that has exacerbated the decline expected from the slowdown, now pulled down into a more noticeable and felt recession. Silver lining, as I mentioned, is 22 and 23 will now be softer. So that's good news for not now, but as we head through the next couple of years, that decline that we initially expected to be more severe will no longer be, that's no longer the case. So what we're looking at is near term, you will feel the decline. If your end users that you service, that you provide to really downstream, you're going to feel, or if they're tied to the consumer, they're most likely going to feel this negativity that we're seeing here, similar to the industrial side as well. But know that 2021 will be a year of rise, and into 2022 as well. Know that it won't surpass today's levels or the recent peak. You'll notice where I'm hovering my mouse over. It won't surpass that level for quite some time, for at least another year. So the next year, we will see at some point some rise going on, but it won't be at the pace since before.
Nothing else coming in.
So then we see, I believe there's someone that's not on mute. If you mind, please, to mute your microphone, that would be appreciated. All right. So just know that near term, we're going to feel this decline, but there is that light at the end of the tunnel for 2021, and then 2022 into 2023, we will start to feel that decline.
If it rolls in the weekend,
all right. All right. Let me see if I can mute my. Again, there is someone that is not on mute. I believe I have everyone on mute, but if you don't mind muting your microphone, that would be appreciated. All right, so perhaps an indicator that you move much better with is U.S. industrial production. What we're looking at here in the blue is the historical data, as well as the orange there was our forecast last time. So this is what you saw, that forecast from the last time we did this type of conversation and presentation. And since then, we have revised our outlook. And you've seen this in if you've read the updated MTI report that was delivered last week. So what we're looking at now is, rather than this softer decline in the orange, we are going to see a more severe decline. And then we're going to see that rise again, similar to the last forecast in the orange. We're going to see that rise still, but then this decline is going to be softer. So that's the optimistic part of the conversation here, compared to the orange, which last time around was much more severe. So these roles have reversed. Rather than a soft decline and then a more severe decline, we're now doing the more severe decline in blue now and the softer decline in 22, 23. So when we look at the level of the V, you'll often hear in the deemed word, we call it, is the V. A lot of economists reference that as the bounce back very quickly, meaning that the decline we're going to be feeling, as steep as it is, we're going to feel that rise as quickly as it was declining. So that is somewhat optimistic as well. But if we draw a line over to 10 years ago, do not compare this decline to what we went through 10 years ago. It simply will not be the same, both from an amplitude perspective and the catalyst to these. The drivers to 10 years ago was economic related. It was a fundamental economic recession. What we're going through now is what we call the black swan event. It was something the economy could not control. It wasn't economic driven. It was this pandemic that came in and wreaked havoc on the economy. Those are two very different perspectives to take when we look at recession. So when you hear that R word, that recession word, as I go through, try not to relate it back to a decade ago. It will not be the same. You'll still feel down, but it won't be comparable. I think a big thing to talk about is disparities within the economy. What markets are doing well? What markets are not doing well? This is critical because you can gain opportunities in the markets that are doing well, and you can stay away from the markets that aren't doing well. I know there's just a lot of pessimism in the market right now. There is a lot of negativity happening, but there are those silver linings that you can capitalize on if you're ready and you have the information at hand. And here we go. Here's the information. General merchandise stores are growing year over year. You can see, focus on this column here. This is the growth, the year over year growth rate that we're seeing in this industry. So we got almost 6% in grocery stores. Obviously, we know the reason for that. We can't go out to eat anymore. Everyone's going to the grocery stores. We're seeing growth there. We're seeing growth in those Home Depot, Lowe's types of building material stores. Everyone's renovating their homes. Everyone's ripping up their carpets or redoing their cabinetry. So those in green there are going to show some really good growth, as well as the non-store retail sales. That's the online shopping that we're seeing, doing some really, really good things right now. whereas you have the negatives that are going on. Clothing and clothing accessory stores, department stores in general are just tanking. So it's important that you look very much downstream, even though you could be very much upstream in the production process and the flow of it. Figuring out where your products or services are ending up downstream is critical, because you can gain opportunities by focusing on these high growth areas and staying away from those negative areas. All right, quickly on the stock market now, I do want to let you know I am not a financial analyst. I'm not an investment analyst. We like to take an economic perspective, an economic look at what's going on in the financial market. Now, what you'll see here is the S&P from February 25th all the way to current day. So a lot of the news and the rhetoric out there is that, oh, we've reached our low point. We've reached our low point in the later parts of March. We've reached that trough. We're kind of back into that recovery trend, that rise. Or check out the title of this page. Dare we think it? There's reasons to believe in the data. We're very data driven. As economists, we're very data driven. So I am very skeptical to say that this is the low point, and the reason for that is this. What we're looking at in the blue is the stock market. Stock prices, the SP5, that's the blue trend. The red trend that you're seeing here is domestic profitability. So naturally and logically, what you would think is that, hey, if corporate profits are up, the stock prices should be up. And if corporate profitability is down, the stock market should be in that descent as well. So that blue and that red line should be typically traveling together. However, we look back to 20 years ago at the Y2K era, we saw that difference in the SP5 and domestic products, or domestic profits. We see the gap, we see the white space between that red and that blue, indicating that there was overinflation in the asset market. Why were corporate profits falling, but the stock market was still doing well? Well, it was overpriced, and then a correction happened, and then they started merging together and traveling together yet again, which is what they're supposed to do. Look at where we are now. So we can still see that gap and that delta between profitability in the stock market. Profits are essentially flat, if not declining, and the stock market up until recently is rising. So even though we saw that decline, you can barely see it because it is a long data history, but you can see that decline still has a gap in between. So I think that there's still room to have that gap close, that red and that blue line merge together, meaning that low that we saw on the two slides or the slide before. I don't think that we have enough data yet to confirm that as a low, because of the reason to believe that there could be this closing of the gap between the red and blue shortly, which could lead to decline in that blue line, which is the stock market again. All right, let's talk about you. Let's take a look at some of the data in the report. To begin, we did end up revising the forecast for MTI, average monthly sales. And the reason for that was because of your relationship to overall U.S. non-defense capital goods, the industrial economy, just in general, our downgrades to the overall industry. Meaning we needed to bake that downgrade into your own forecast itself. So what we're seeing here let's start at the bottom. We're looking at the bottom left, the overall MTI sales data history in the blue. The yellow is our forecast. So we did end up revising. You're going to expect to see more descent for at least another year, maybe 5 quarters more before that trough takes hold and rise begins. Now, unfortunately, that rise where it gets to at the end of the forecast in early 23 will still be below today's levels. So know that over the course of the next 3 years, 12 quarters, that levels will not return to where we expect them to be today, unless there are things you're doing internally differently that would warrant that change, that would warrant you to gain market share, or to do things that could to potentially put you back up to today's levels. And the reason for that being the decline in the economy that we're seeing, the decline in utilization rates and investment activity, that's not going to encourage new opportunity for MTI itself. So on the right-hand side is the growth rates. Those are the above zero, growing below zero. Let's look at that business cycle itself. We can see the quarterly growth in black there and the annual growth in blue, as well as the moving forward. So we do have another year of descent coming from those rates of change, similar to what I talked about with the overall industrial economy, where the low point will be felt severely, but it won't be to the amplitude of what was felt 10 years ago in the Great Recession. And you'll see that on the left-hand side too. The level of the low, I drew a straight line across, much higher this time than the level of the low 10 years ago. So know that we do have that as the silver lining. This is not comparable to a decade ago, but there is going to be an imminent transition to phase D recession. You'll see that up here with the rates of change. We see that over the course of the next year, you will be in that recession, troughing out in the early parts of 2021 at negative 21.1% contraction. So that's noticeable contraction. We have closed the year closing out in 2020 at almost 20%, at negative 18% contraction before rise takes hold. However, even through 21, you'll notice that this will be characterized by recovery. 2021 will still close out the year below 2020's levels. So there won't be as many opportunities coming your way in the next 2 years, and even during that rising trend, it will still be below today's levels. The growth period for the middle parts, or the first 3 quarters of 2022, before that slowdown happens again. But it will be characterized for all of 22 and into the first part of 23 will still be positive. There's no negative growth rates there. It's all positive year-over-year growth. That's encouraging for as you head into 2022 and into 2023, that there is still growth potential from MTI. So now let's look at the historical data for the last year, the average monthly reported data. We can see that December of 19 clearly saw a lot of that negativity. I'm not as much concerned about this because if you did notice that in the data on the previous slide, you're seasonal. So this quarterly data in the black on the left goes up and down, up and down. That's because it operates on a seasonal level. December or in January typically are the low points of seasonality, and in the middle parts of the year, those summer months seem to be where you see those higher parts of seasonality trends. So we have seen that typical rise coming from the business from December to March, but that's expected due to what I just mentioned, the seasonal pattern. It's normal to see sales rise from the winter months to the summer months. You're still going to enter into that phase D recession imminently, despite the monthly sales rise generally that you've been feeling over the course of the past 4 months. So what's telling us that your business is heading in this direction? Well, we've already looked at this before. This is U.S. industrial production. We saw that a few slides ago, but this is overlaying your business, or MTI, I would say, over U.S. industrial production, particularly on the right-hand side here. So we're seeing MTI in the yellow, as well as the orange forecast, move very, very well with overall U.S. industrial production. Especially historically, we can see that every single cycle essentially was picked up by the industrial economy. There's a really great relationship there, a solid relationship, and that's informing our expectation for the direction. So we will see that negativity as we head through the next year before things pick back up again in 2021, especially into 22, we're going to see that more noticeable growth. Another really great trend, really great market you move with is B2B activity. So that's, I call it B2B activity. U.S. non-defense capital goods new orders is a very long name for capital equipment expenditures. So B2B, What's going on in investment activity? Well, what we're seeing in the corporate profitability level, you saw it on that financial slide, where it's somewhat flattening, if not declining, as well as utilization going down. We'll see that shortly as well, really telling us there's no incentive right now for businesses to go out and invest in new capital equipment. There's no money there. There's no incentive because there's no demand going on. So that's really going to discourage the B2B activity that we're expecting. And you'll notice that way more severely on the left-hand side, or much more severely on the left-hand side, because you'll notice, similar to where we expect MTI to go, we're going to see that decline in the blue in our forecast there, but the rise will not return to current levels. This is going to be well below the current level, even through 22-23. So know that. And a large reason for that too, I believe, is because businesses sometimes they take that fear with them even outside the recession, even outside the recovery. They say things are better. The data may show it's better, but there's still that risk averse mentality to say, you know, I'm going to hold on. I'm still not confident. So that will likely drag down the dollars spent on new capital equipment, new business activity. So some industry drivers, other than that's what's included in your report, other than what we've talked about so far, is a big one is machinery manufacturing capacity utilization. So I just mentioned this. What we're looking at here is the bottom part is looking at the percent. So that's 76.4% utilization of capacity. We see it on a growth cycle above, and you'll notice this looks very much like the previous non-defense capital goods B2B slide, as well as the industrial slide. If machinery is not being used, there is no incentive, and that's what we're seeing. We're seeing the utilization rates right now at 76.4 creep down from the peak that it went through, which is why we see all the way from 16 to 2018, we saw that really great rise happening in utilization as businesses and machinery is becoming more busy and and having a lot of output. That's why we saw a B2B activity really rise noticeably during that time as well. So now we're traversing the backside of that situation, where we're seeing lower amounts of investment because it's just less busy. Copper prices also tell a good story, where we like to call we like to say copper has a doctorate in economics, so Dr. Copper, because it's so widely used in almost every single industry that demand for copper and the movements in prices as a result of that really portend what's going on in the demand for the global economy and the US economy. So we have been seeing copper prices below zero. They're down over 7.5% right now, and that's going to lead to some negativity coming in overall investment as well. As we see not just copper itself, we're seeing it in especially oil prices, other commodities such as steel, aluminum. The pattern is pretty similar amongst all other commodities as well, just an indication of demand. All right, so the last part of the section is, and I know that you likely, if you've been listening in the past on these types of report reviews, is that I have shown this in the past, but I do want to kind of tie in what this downturn, this newly downward revised outlook has, if it has an impact on 2030. I want to say yes and no. Yes, it has an impact because we're going to just increase our debt more and more. So a lot of people ask me, "Hey, Kat, is this recession that we're going through now going to happen and mean that we're not going to see it 10 years into the future?" No, that is not the case. The drivers that we're seeing here still at hand. We're still going to see this depression. And I say, instead of the R word recession, I'm saying depression with a D. We're still going to see this depression in 2030 driven by these factors. And number 5 is a big one. Our debt as a percentage of GDP is going to climb. Right now it's 122%. And that's going to keep growing if we're not changing anything, especially with these stimulus packages that are going on. That's going to really hurt us. And this kind of goes to show that trend here, where we have the transfer payments in red at the top. That's Medicare, Medicaid, Social Security. We have tax receipts below that. So not even considering the orange and the green line, which is also of concern. We're just considering the top two lines there. We're paying out much more than we're taking in. Especially now with the stimulus programs, our debt is just going to climb. So if anything, this is going to add on to the fact that we expect or further confirm our 2030 depression, not prevent it. And that's the picture I want to paint here, right? So you've seen this before, again, if you're familiar, where we look at what is the next 20 years going to look like. Now, this is not a forecast for the future. This is the 1920s and 1930s. So this is looking at the economy in the past, which is what we expect similar to the next 20 years, where a lot of people think the roaring 20s was just rise. There were actually 3 recessions in the 1920s during that roaring prosperity. So what we're seeing here is that we're still going to go, we're in a recession right now. That goes to show that we're still going to be in an overall ascent in the 20s, but then we're going to demonstrate that really sharp depression in 2030. So I like to call it the stairway to heaven, the next 10 years, and then the highway to hell as we go through the 30s. All right, so before I turn it over to the questions, I do want to make sure that this type of information is coming to use in a practical manner. So how can I utilize this information? Making sure your cash flow modeling is reliable, taking advantage of the CARES Act. I've seen 2 sides of the story where we have businesses that are hopping on this as quick as they can, and then some others they don't know how to apply for it. They're kind of dragging their feet, not acting quickly. So really making sure you're acting quickly on this. I'm not going to read all of these through verbatim, but knowing which markets are doing better than others. Clearly, we know that the grocery store market and the online market's doing well, whereas there are other boots on the ground type of, the brick and mortar stores aren't doing so hot. Know that. Do the research. Know where to put your eggs into certain baskets. And develop your own rates of change. Timing is everything. That is something that we see it in the MTI data itself, where we're noticing that those quarterly rates of change are falling. That means we're going to see that decline still to come in the annual rates of change. So know that tracking your rates of change is really crucial. All right. So please subscribe to the Trends Report. You can get a 90-day trial offer by texting TR Trial to set 33777. It's a really great read. It's a monthly, essentially a subscription. I don't want to call it a magazine, but it comes in that type of format where you can read through every single type of market, housing market, construction market, manufacturing market, global economy, with forecasts for nearly all of them. It's a really great read. I encourage you to do that. So at this point, I will take the last 10 minutes to turn it over to some Q&A. So please feel free to, again, utilize that chat box there and then ask your questions as we go through. It's in the top, it should be in the top bar there. You'll see a more section and then hit chat and I'll be happy to answer your questions. All right, so the first question I have, the first and only question so far is, does the market prediction with MTI also hold true with aerospace and defense companies? Should we expect them to decline following the MTI trends through 2023? So that's a great question. And there's multiple, there could be a positive answer to that and there could be a negative answer to that. So aerospace and aircraft in general, that's in a big decline right now. Clearly, no one's hopping on the plane. So when we look at just aircraft and aerospace itself, that will follow the MTI trends with the negativity throughout. Defense industries typically do not move in sync with overall the industrial economy. We typically see different types of movement for the positive. So yes, defense is a great area to kind of buoy the negativity elsewhere. So yes, focus on defense because that's going to be the better side of things. I know that happens a lot where you shift into defense and even government types of projects during times of decline to buoy that negativity. All right, we have another question here. What effect will prolonged or new outbreaks of COVID have on the forecast if they extend beyond summer 2020? Well, definitely negative impacts. That's something that could certainly take hold, where if we release the stay-at-home order too quickly and we have a kind of a secondary pandemic, that would warrant a new consideration to the forecast. You're absolutely right. So what we do is we base our forecast off of the information that we have at hand, and the assumption that we're making right now is that this will come to an end in the midsummer. If that is not the case and that does not transpire and we see a second round of this COVID, we will have to lower our outlook, and as a result of that, we will subsequently have to lower the MTI outlook again as well. But right now, I'm not going to make that assumption yet until I start to see it play out in the data. Again, we're very numbers driven. All right, my next question is, why do you think March and April was so strong and May thus far is very weak? So a big thing there is, I think March and April, one, a lot of businesses can typically have a strong backlog to hold them over, even when the COVID-19 was present through March and April. Projects were maybe midway through or even early on in March and April, like if it started in February. May is when it's starting to actually manifest itself in the negativity, where we're seeing that decline happen. So I've seen that a lot, where March and April, especially in some of the market data as well, is still strong because of the backlog that can hold individuals over, which actually is a great point to make to kind of add on, to piggyback off of that. Controlling your backlog is a very strategic thing to do when you know a decline is happening. So knowing that this is going to last forever, or knowing when the next decline is coming, when you're still feeling good. I'm not saying that we're in the case right now, but let's say the next downturn, knowing that it's coming, utilizing our forecast, start building that backlog and managing it so we can buoy you through that negativity. That's a great strategy to have. What inflation rates can we anticipate in the next 1 to 3 years following the extreme government spending, was that next question. So that is interesting, because it's somewhat of a balancing act, right? Where you look at the pumping of money into the economy is going to cause inflation, but at the same time, there's the decline in demand is offsetting that. Lower demand, lower inflation. So we don't think it's going to be inflationary because of the lower demand that's happening. And then the add-on to that was, what about wage inflation? Wage inflation, I believe, won't be as aggressive as it once was. And the reason for that is, one, purchasing power has essentially increased. If prices are low, and let's say your salary stays the same, you can now purchase more items. Your purchasing power is the same. And we're not in the same situation as I was maybe talking about 6 months or a year ago, where the bargaining power was in the hands of the employee and not the employer. We're now in a situation where it's somewhat giving a little bit of that power back to the employer, where they can now somewhat control the wages that they're giving, which wasn't the case a year ago. So I think that there won't be as aggressive of wages at that point. That was the last of the questions so far. I will give it, let's say, 1 more minute if anyone wants to chime in with any last second questions. I will let you know this will be recorded. If you have any follow-up questions that you think of later on, feel free to email myself or Tom. I'll be happy to answer anything that comes my way in the meantime. So far, no extra questions have came in, and I appreciate all your time today. Please take advantage of the report and the information. I know that there's a lot of pessimistic conversations out there, but really, really try to take advantage of that. I really hope you walk away with something to change in your daily business or personal lives. All right, everyone. Appreciate the time and take care and have a great rest of your week. Bye-bye.